Hi, I'm Michael Taila, Director of Fixed Income at City National Rochdale, and welcome to this month's edition of Fixed Income Perspectives. We are now midway through March. The primary driver of volatility continues to be policy uncertainty as tariffs take center stage. Within fixed income, sentiment has shifted as market participants are now more concerned about the potential for federal policy actions to slow growth. This has been aided by commentary from the Trump administration that the economy now faces a period of transition as it moves away from deficit-financed growth to a more private-based model. This is evident in U.S. Treasuries, where yields today are lower across the curve after peaking in mid-January, as the markets were balancing expectations for strong economic activity and the possibility of higher inflation. This change in investor behavior has also led traders to increase their bets for Fed easing, from forecasting one cut to the overnight lending rate to at least 3 cuts in the second half of the year. Against this backdrop, we're seeing the fixed income markets remain resilient and benefit from risk-off market periods and declining yields. Year-to-date, performance for key segments is positive, with intermediate municipal and corporate bonds returning just over 1.5%. Within high yield and opportunistic income, attractive starting yields have cushioned rate volatility, helping generate positive returns here as well. One theme we continue monitoring is credit spread, or that extra yield an investor requires for taking on various risks. Credit spreads for taxable and tax-exempt bonds have bounced around multi-year lows for quite some time, as solid issuer fundamentals and underlying economic strength provide price support. Looking at the corporate market, we are beginning to see a normalization in spreads that translates into more attractive valuations. Concerns over the impact of trade policy has allowed spreads to widen modestly from mid-2024 lows. But the pricing of risk has held nicely in this environment, and we would view any dislocation as a compelling entry point for longer-term investors. Similarly, the municipal bond market has also experienced solid price and spread support. Improvements in credit quality over the past several years from pandemic-era stimulus and strong budget performance have bolstered the balance sheets for many issuers, leading to upgrades exceeding downgrades for 4 consecutive years. The pace of upgrades is likely to moderate as risks to the market and economy evolve, but we're closely monitoring how federal policy changes and potential tax reform can impact the broader market. But we anticipate issuer quality to largely remain resilient. With this in mind, we expect security selection to play a more prominent role in sourcing opportunities. To wrap up the discussion today, we currently view the overall U.S. growth outlook as constructive. Despite a softening in investor confidence, underlying wage and income indicators suggest consumer fundamentals remain intact. Policy uncertainty does continue to dominate the market, with tariff threats now becoming tangible realities. However, the full policy landscape has yet to emerge as deregulation, tax policy, and the budget remain key unknowns. At CNR, we continue to forecast between 1 to 2 Fed cuts this year and longer-term yields to remain range-bound near 4%. While yields remain attractive across various fixed income asset classes and credit fundamentals intact, should spreads widen as the market reprices risk, we would view dislocation as an opportunity for investors. We continue to reinforce security selection in the current market environment. Thank you for watching this month's edition of Fixed Income Perspectives. Feel free to reach out if you have any questions.